We saw a big repricing yesterday. Relative to history, it wasn't that big, but where we are now, it feels substantial. What does that mean for the credit portfolios that you look at?
Well, it means that we're sitting on some total return losses, which probably doesn't feel particularly good for a lot of credit investors. And that really affirms our outlook that investors should be preferring credit risk to duration risk right now. Curves are exceedingly flat, even with this recent move in yields that we've seen. And economic fundamentals are still recovering and pretty much on pace to remain really intact from a credit perspective, despite the fact that we have a lot of headaches when it comes to inflation.
It does seem, though, that the UK and the US, for example, may be on a touch of a different trajectory when it comes to the ECB. I mean, look at the move in break-evens. Break-evens higher here, not really moving anywhere in Europe. Real rates moving higher here, not really moving anywhere in Europe. And I wonder what kind of relative opportunity that might unfold.
Yeah, that's a really good point. And, you know, in the UK, you obviously have compounded headaches related to Brexit with supply chain and labor and inflation. And I think that it's really important to consider that the Fed is the really significant driver of global monetary policy. The US markets are the most liquid, they're the largest. And so when investors are kind of considering global relative value, particularly in fixed income, I think that the US is going to lead the way in a little bit because a lot of investors are viewing the US markets as a cash surrogate right now and really keeping a keen eye to the Fed. And then just expecting a lot of the other central banks to be a bit more of a follower, despite the fact that we have seen some hawkish messaging and tightening from some of the European central banks, from some of the EM central banks. And so it's a really interesting kind of study and contrast right now across fixed income and the rates markets.
Companies still have a lot of cash on their balance sheets. Should we be worrying about the credit market in this kind of environment? There's a lot of stresses and strains on companies, but companies have cash. Where do you think that the stresses and strains, therefore, are going to show up as we start potentially to see rates going higher? We potentially see tapering coming through from the Fed and potentially the Bank of England as well. How big a buffer do you think that cash is going to be?
I think that the buffer is pretty tremendous right now. Over the past 18 months, all we've done is see issuers really load up on cash, really fortify their balance sheets, and try to make sure that they have enough liquidity to preserve for a rainy day or for more challenges to come. So the big question that I'm asking myself and talking to investors about is, over the next 3 to 6 months, how do companies start to use that cash? Are we going to actually see deleveraging and debt paydown? My expectation there is probably not, given just how cheap borrowing costs are right now. And instead, I think that we're going to see a lot of cash siphoned back into the equity side of things through dividends, share buyback programs. And that's actually the more challenging fundamental catalyst that I'm looking for right now. I feel pretty confident about most issuers' ability to manage through some of the supply chain and inflation headaches. But once we start directing cash towards equity holders instead of into the business or towards bond holders, then that's where fundamentals start to get a little bit more concerning.
It feels like the question for equity investors when it comes to, say, value, if you have higher inflation, if you have higher rates, you would think that means you're going to have a shift into value, which leads you to kind of Europe. But I wonder what the knock-on effect then is when it comes to the credit market there and sovereigns over there. Is there like an equal kind of trade to that?
You know, that's a little bit harder to say. In the European credit markets, we've also been focused much more on taking credit risk rather than duration, you know, looking for things like hybrids or the energy sector or AT1s where you're still getting some yield and relatively short duration. Now, the European credit markets do benefit from shorter duration relative to the US overall, but absolute yields are just so absolutely low that it's really hard to look at that and say, you know, this is the time to really go in whole hog right now. But one of the things that I think is really interesting is the European credit markets have been very resilient amid the broader volatility and backdrop that we've seen.
What about the rest of the world? We've talked about the US, we've talked about what is happening here in Europe. How infected could global credit be by, for instance, what's happening with Evergrande? We were talking to Bruce Richards from Marathon a few minutes ago just about this subject. I'm wondering if there are factors that could knock what appears to be a very solid credit picture that you've just laid out off course, And do some of those risks emanate from outside Europe and outside the United States?
I think that's a really good point. Investors have been keenly focused on the Evergrande situation. I think right now the general view is that a takedown of Evergrande and a default there is probably not going to have global systemic issues, given that much of the global banking community is fairly well insulated from really outsized exposure, and that's where you would start to get very concerned about kind of global contagion. But the reality is that Chinese growth and GDP is pretty significant for global growth. And so if you start to have a deceleration in China, then you do start to feel the effects further out across the world. Now, the offset to that is then you potentially have a little bit less pressure on central banks to be aggressively, or aggressively in the current context, tightening monetary policy. And so there are some kind of gives and takes there. But clearly China and kind of how the Evergrande situation plays out and the implications for growth there and then global growth is something that we're monitoring pretty closely, particularly in conjunction with all of the U.S. debt ceiling negotiations or non-negotiations that are occurring right now. It feels like we could have a little bit of a perfect storm.